What if you combined two of the most popular candlesticks into one single candle? What if you took the pin bar and the engulfing bar and merged them into one pattern? It would appear something like this: a candle which engulfs the previous bar and which has a big wick on top or at the bottom of it. I've backtested this pattern in the recent week and the results are promising. Found in the right chart locations, this pattern offers pretty good trading opportunities. So let me share my discoveries using the engulfing pin bar formation. So like, subscribe, and stick around for the full video. So this pattern is a hybrid of two candlesticks, and it must meet several conditions. First condition: the candle body must completely cover the previous candle body, with a close above the high or below the low of the previous candle. If the close is above the high of the previous candle, then it's bullish pressure, while if the close is below the low of the previous candle, this signals selling pressure. The second condition: the candle must contain a wick. The wick, or the shadow of the pin bar, shows the area of price that was rejected, and the implication is that price will continue to move in the opposite direction of the wick. A bearish pin bar signal is one that has an upper tail showing rejection of higher prices, with the implication that price will fall in the near term. A bullish pin bar signal has a lower tail showing rejection of lower prices, with the implication that price will rise in the near term. The engulfing pin bar candlestick is one of the best ways to get into trending moves just as momentum is picking up. These candles indicate a strong shift in direction because they contain not one, but two signals in one candle. So let's consider this bullish engulfing pin bar candle. First, it formed after an extended move down. It signals exhaustion in the market, where sellers begin to book profits and buyers begin to take an interest, thus pushing prices higher. The previous candle is completely contained within the engulfing candle's range. This is the first signal indicating buying pressure. Also, the wick indicates a possible reversal and rejection of price. That's the second signal within the same candle. You see why this pattern is more powerful than a simple engulfing or a simple pin bar. It's an ideal setup to trade on higher timeframes, either from pullbacks to key levels or as breakout trades in trending markets. Remember, trading candlesticks from incorrect areas on the chart is probably the biggest problem, which is getting traders into trouble. You cannot enter a trade just because you see this pattern. The engulfing pin bar has a higher chance of reversal if it appears at a strong area of support and resistance, or inside or very close to a supply or demand area. When combined with a strong support or resistance level, engulfing pin bars can be one of the most accurate trading signals. In this chart, we can see a nice example of an engulfing pin bar pattern that formed following a pullback to a support level in an upward trending market. When trading this pattern, you have several entry options. The first, and perhaps the most popular, is entering at the market. You enter the trade at the current market price after the candle was completed. Another entry option, and my preferred method, is by using a stop entry, placed just above the high of the pin bar. This pattern is very powerful because it gives you the chance to get a good entry and allows you to get a tight stop loss, either below the bar or below the key support level. Here's another example of an engulfing pin bar. This time is more of a reversal pattern because it formed at a resistance level, causing a false break of this resistance level, and then set off a move to the downside. A possible liquidity clear out. We'll talk about this later. This pattern, again, allows you to get a tight entry by entering when the low of the candle is broken. The stop loss is placed just above the resistance level or above the candle's high. We can see a dramatic sell-off unfolded as price broke down below the signal candle. I like to use this pattern in combination with VWAP, especially when I'm day trading. VWAP shows the average price weighted by volume, and it's one of the most useful tools for entry and exit points. VWAP provides a context of trend depending on where the price is trading, above or below, in relation to the VWAP line. A market trading above the VWAP as the line rises indicates an uptrend, and vice versa on a downtrend. Plus, it offers dynamic support and resistance. And when you find an engulfing pin bar forming near the VWAP line, you have a high probability area to trade from. So when price is below the VWAP, the market is bearish, and you want to find bearish engulfing pin bars after a pullback to the VWAP line. When price is above the VWAP, the market is bullish, and you want to find bullish engulfing pin bars, again, after a pullback to the VWAP line. In this example, we added the weekly VWAP. We see the market making higher highs and higher lows, with price trading above the VWAP. And here's the signal candle. The high and the low of the engulfing bar extend beyond the highs and the lows of the previous bar. We also have a wick below the bar, rejecting the VWAP line. And we also have this support level right here. This is a textbook example. Stop loss is placed below the signal candle and below the VWAP, and you target double the amount you risked, or you set a take profit below previous market swings. In this Euro-USD chart, we added the monthly VWAP. We are in a consolidation phase, with price trading mostly below the VWAP. And here's the signal candle. The high and the low of this bearish engulfing bar extend beyond the highs and the lows of the previous bar. Observe this large wick above the bar, rejecting the VWAP line. And we also have this resistance level right here, or a supply zone. When price breaks below the low of the candle, we have a good opportunity to short the market. Stop loss is placed above the signal candle and above the VWAP. I also see a trend line breakout, which is another confluence factor, signaling bearish pressure. First take profit is around this area at this swing low, and another one is at the next swing low in the price structure. Now here's an important tip. The size of the candle matters. You need to avoid very large bars. Not only they affect the risk to reward, but it also means you missed the actual move itself. Look at this bearish engulfing pin bar that represents a rejection of the monthly VWAP line. This is a huge candle of almost 200 pips. Entering at the close of this bearish engulfing bar would have caused much pain. If you planned to enter here, you were too late. The move already happened. As a side note, if you used the second entry method with a stop order below the low of the candle, you would have avoided the loss. That's why I use this method myself. If you don't have a good follow-up after the candle, meaning if price doesn't break the low of the candle, you simply avoid the setup. You want immediate reaction after the formation of the engulfing pin bar. Remember, we have two rejection signals in one candle. If the market doesn't have the power to break below the low of the candle, it means the momentum is not there. So, avoid the large engulfing pin bars. They obviously contain a good part of the expected move within their range. It's very common for engulfing pin bars that close strongly, meaning having little to no wick, to break in the expected direction fairly quickly. If the high of a bullish engulfing pin bar also represents the close of the bar, this is a much stronger buy signal. The same with bearish engulfing pin bars. If the low of a bearish engulfing pin bar also represents the close of the bar, this is a much stronger sell signal. So, a candlestick which closes with no shadows is regarded as a strong signal of conviction by either buyers or sellers, depending on whether the direction of the candle is up or down. In this chart, this type of candle is found in an uptrend and signals that the bulls are aggressively buying, and it suggests that momentum may continue upward. And here's an example of a weak bearish engulfing pin bar. Notice that it leaves a wick on the lower side, the side you would expect the bar to break from. We didn't have immediate follow-through. Sure, the market eventually broke its low and continued downward, but from a risk management point of view, this wasn't the best trade. The risk-to-reward ratio is quite bad. I prefer to trade candles that print little to no wick. I don't want any signs of pressure from the other side of the market. And it goes without saying, don't trade bullish signals during downtrends or bearish signals during uptrends. Instead, go with the main trend. Once the trend is established, wait for a pullback. You're getting a better price for the next wave of the trend when it unfolds. If you followed my channel, you know I'm a big fan of trading liquidity clearouts. The market always seeks liquidity. Liquidity rests above previous highs and below previous lows, as many traders see these obvious points to place their stop loss. These are the areas in the chart where many orders are placed together and serve as tipping points for market makers and smart money. If you find an engulfing pin bar after a liquidity clearout, well, you have a great opportunity to enter right after many traders are being trapped with losing positions. Here's Bitcoin. I see an aggressive up move, a correction, and now we are in a consolidation phase. Some may say it's an accumulation area. Look at this support area right here. Lots of orders are placed below it, plus a lot of breakout traders ready to short below the level. And here's our engulfing pin bar, breaching the support level. That was a liquidity clearout, or a spring in Wyckoff terms. And when price breaks the high of the signal candle, you have a chance to enter and profit from trapped traders. Stop loss below the candle, and a risk-to-reward ratio of 2. Here's another liquidity clearout, this time at a resistance level. We have this area, quite choppy, with many wicks to the upside, suggesting a bearish pressure. When market returned once again to this resistance area, it slightly broke that level and triggered the stop-loss orders of traders. The stop-loss orders forced those traders out of their positions, and once those orders are cleared, the market reverses. And look at the candle which followed the fake breakout. It was an engulfing pin bar. The entry occurred when the low of the candle is broken. Not the cleanest setup, because we had a small wick below the candle. We had a period of consolidation, but the market was making lower highs, so this was a valid trade. Now, if you want to learn more about finding the best liquidity clearout signals, make sure you watch this video here. And check out our Academy program if you want to further level up your trading. Until next time.